I'm Albert Liu, and in the lead up to the 46th Annual New Orleans Investment Conference, it's my pleasure to welcome back Danielle DiMartino Booth. She's the CEO and Chief Strategist of Quill Intelligence. She's also the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. She's a Bloomberg View columnist and most notably a former advisor to Richard Fisher at the Dallas Federal Reserve Bank. Danielle, great to see you again. How are you?
I'm great, thanks, Albert. How are you? It's good to be here. I wish we were doing this live in New Orleans, but I don't think I'm alone.
Yes, you're absolutely not alone. It's one of the conferences that we all love to attend, not just for the content, but for all of the what comes along with being in New Orleans. We'll do our best to deliver at least the content portion to our attendees this year. I'm so happy that you're joining the conference once again. Last time we spoke, we touched upon a hot button issue with you, which was inequality. And so I just want to start with that because some Federal Reserve data came out, which seemed to indicate that at least income inequality for the first 3 years of the Trump administration had narrowed. Unfortunately, wealth inequality did not improve. What are your thoughts on this report? Should we be paying much attention to this?
Well, there's a good reason we should be paying a lot of attention to it. And that is because I think right now, Federal Reserve officials are looking at those 3 years of being a time when there were plenty of critics saying, myself included, saying that if you keep interest rates too low for too long, because you want to draw the marginal worker off of the sideline, the person who's been disenfranchised, the worker who's been gone for a decade, if you keep rates that low for that long, with noble aims in order to close the inequality divide, at least when it comes to income, but not wealth, ... You're going to set up a situation where there's going to be so much leverage in the system that in order to correct for that, you're going to wipe out years of gains and look at where we are now. But the reason investors should pay such close attention to it is because in one of Jay Powell's recent press conferences, he made the point that said we had interest rates at the zero bound for 7 years and didn't create a bubble. Well, A, that's flat wrong. We've already seen that the bubble has been created, but that's not the point. The point is that now I think Fed policymakers are saying, well, if 7 years started to close the inequality divide, maybe we'll keep interest rates at the zero bound for a decade and see what happens.
Danielle, I'm wondering how this works because you have rising wages, which in part contributed to this narrowing of income. But if you have rising wages combined with really cheap access to capital, doesn't that set the stage for basically machines replacing people in the labor force?
It does, and sadly enough, Albert, it has. And what we're seeing is that many small businesses in America had come to rely on how cheap U.S. labor was at the bottom rungs of the income ladder. And so they were operating their small businesses in a very capital-intensive manner with lots of labor. And in a post-pandemic world, the conclusion has been quickly drawn that you know what, if I'm going to stay in business, my customers actually want less in the way of human interaction. So it's going to push the automation that has always been present at medium and large size companies looking to contain costs. But it's going to push that cost containment effort all the way down to the smallest businesses in America. They're going to be induced to automate, and that means that we could have an even more prolonged period of time when you have very high permanent joblessness in the US economy, which I think is what is beginning to manifest in what we're seeing with people who are unemployed. Each jobs report that comes out, we're seeing that they're unemployed for a longer and longer and longer period of time, and no longer maybe temporary in nature, but permanent.
Yeah, and I want to talk about the Federal Reserve, but since you bring up issues of the real economy, let's start with that. I was on my walk this morning, Danielle. I stopped for a cup of coffee, as I do sometimes, and my online mobile app was not working. So I went in, I did this thing called standing in line in front of the cashier Finally got to the top thinking, what a drag this is. And I thought, should I tell this young man that his app is broken? And I thought, well, you know what? He knows because everyone uses this thing. And if I don't tell him, someone else will. And so I stepped to the side, and sure enough, the next person behind me walks up with this confused look on his face, holding his phone, says, I tried to order this thing, but look right here. When I push locate nearest store, nothing comes up. And he's showing his screen to the young man there. And he's like, look, see this? And then I do this, and then I do that, and it doesn't work. And the young man, he patiently listened. And when the gentleman was finished, he said, well, I can take your order right here. And he said, oh, right. And he ordered. And basically this cashier has been reduced to a help desk in this is a Starbucks. So, we, like you mentioned, we do have unemployment. The unemployment seems to be possibly permanent in a lot of cases, in a lot of jobs. So where do you see this going? Because it looks like there's been some permanent changes to the economy. And I don't know if that has been fully understood yet.
I don't think that we have a good grasp of what has taken place. We're just now at the point where the extra executive memoranda that President Trump signed that gave an extra $300 a week in unemployment benefits, and then the states matched it by another $100. So people who were collecting unemployment went from an extra $600 a week to an extra $400 a week. That in and of itself slowed retail spending some. But now we're at the point where markets are thrown about by the size of the next stimulus package and whether or not there's going to be a next stimulus package. And I think we've come to the point, and I don't think most of us want to look this far out on the horizon and make this deduction. But if we are going to have permanent joblessness, as it's becoming apparent that we are, we're going to become an economy that is increasingly dependent on the next stimulus bill. And that is a really slippery slope when you consider that the alternative, and what I've read about recently and am a huge proponent of, is what Germany did in 2005, 6, 2007. And that is that they retrained their workforce. They put vocational training on steroids. And there is something to be said for all of the stimulus spending that could be directed towards productive means in this country, like infrastructure spending, that would not only put Americans to work who are out of work, skilled jobs that pay well, but it would also decrease commuting times, to take but one example, and make for a better life for a lot of Americans in the long run. And by the way, help China not cook our lunch in the long run, because when they put stimulus money into their economy, they tend to get something for it. But because of this permanent joblessness, my concern is that politicians, being right of heart but wrong of mind, are just going to continue passing one stimulus bill after another in order to throw income at the problem, but that won't resolve anything in terms of generating escape velocity for the economy. And that is a concern.
Yeah, I think you nailed it when you said right of heart, wrong of mind. What I'm seeing now, and you probably have seen the data, I'm just looking around in my own environment, that October is going to be a pretty bad month for business closures, restaurants and whatnot, who have been hanging on for a long time, but are so behind on their rent that there's no way that they could really recover from that. Some of my favorites, Danielle, are closing, so I personally feel a loss. But at the same time, with all the stimulus and support that is being thrown around, I'm afraid that we're removing the competitive aspect out of the economy. I mean, the economy is a competition. Nature, in fact, is a competition. And that's what keeps it going. And I feel like if we leave it alone, there'll be losses, but the stronger businesses will survive. The ones that are well adapted to the new circumstances, meaning outdoor dining, spaced out seating. Are you worried that we're doing too much and, like I said, eliminating the competitive aspect, which is a necessity in the economy?
Again, I'm going to go back to but one country, and that is Germany. But you can look at many different examples around the world of countries where there is an option, but if you're not well suited to a four-year education, then you're going to gain a skill, and you're going to become part of the economy in that manner. And in fact, Germany, unlike its other European peers, has taken its youth unemployment rate down to single digits as a result of focusing on what people are good at, as opposed to throwing money at them in order to stay out of the workforce. Because you're right, you're going to end up further encouraging what a trend that we've already started to see, which is that it's only the biggest companies that end up being the most competitive, efficient producers in these types of economies, as opposed to what we like to think of: innovators, entrepreneurs, employers. So there is this very slippery slope, and there's right-minded concern, and it's not out of a lack of compassion, but rather it's because you want the quality of life of recipients of stimulus to improve beyond the next stimulus check. And I think that is really what our politicians, the onus is on them to stop before they just keep writing new checks and say, what is this going to accomplish for the recipient of the stimulus in the long term?
Agreed. Let's shift gears to the Fed. I always count on you to translate what I'm hearing from Fed minutes and Fed press conferences. The Fed has a new target. They're forecasting low rates, I believe, until 2023. And they're also talking about averaged out 2% inflation. I'd like to get your take on what that actually means in real terms. English, I mean.
In real terms, I think it means absolutely nothing. The Fed's own projections out to 2023 show that the core PCE, according to their forecast, is going to hit 1.7%. And out of the other side of their mouths, they're saying that they're going to let inflation run hot and beyond 2%, up to 2.5%, maybe 3%, in order to average it out over the past, since 2008, that they failed on this mandate. Ben Bernanke imposed a 2% target in January 2012. Since January 2012, the Fed has hit in 11 whole months, they've hit that 2% target. Meaning, they have an inflation metric that is broken by design. It underreports housing inflation. It underreports healthcare inflation, using Medicare and Medicaid reimbursement rates into the imputation of the core PCE. It's by design not going to hit that 2% level. But what the Fed is trying to tell you is that they're going to have a reason. They're going to have an excuse by which to continue printing money, by which to continue Treasury purchases. And the reason that there's been such panic among Fed officials, and this is no hyperbole, there is a sense of panic among Fed officials. They're saying, please, politicians, get back on the Hill, don't recess, don't leave, pass the stimulus legislation. It's because Fed officials are desperate for more money to print. And all that's saying that they're going to let inflation run hot, even though they know it won't under the construct, is saying that because we know inflation is going to be below our target going forward, we're going to be able to continue to buy up as many treasuries as humanly possible, which is the only transmission mechanism, by the way, that allows the dollar to weaken and allows the United States, by extension, to be more competitive. Right now, we've got the European Central Bank's balance sheet growing at a faster pace, and lo and behold, the dollar is strengthening and the euro is weakening. It is by design. There's an 83% correlation between the size of the Fed's balance sheet and the euro, and it does not work so well in reverse. So in other words, the quicker we grow the Fed's balance sheet, the weaker the dollar is going to be, the stronger the euro is going to be. And that applies to every central bank that has the power of the printing press as we continue to engage in this very long and ongoing currency war. Because that's the only way that you can try and fight economic sclerosis, with the creation of debt.
Right. And, you mentioned that the Fed has a tendency to underestimate or use metrics that underestimate real inflation. So the fact that, as you mentioned, core PCE is down far below 2% doesn't really help the average person. As you mentioned, the way medical costs are factored in, the way rent is factored in, and then the fact that it's core means you're not counting food and energy. You know, X energy is not like an ex boss or ex girlfriend or ex boyfriend. Calling it an ex doesn't get the energy and the food out of your life. It's still very much there. And I'm wondering if the numbers that you cited, the fact that during the Bernanke tenure, you know, this measure of inflation was very low. Well, that was before we went absolutely nuclear earlier this year with, balance sheet expansion and other programs, not to mention what might be coming, as you alluded to, in 2021 in terms of government stimulus. Don't you think that there is a chance that we'll blow past 2% and they're just clearing the way for that here with this new outlook?
Well, possibly, but you have to understand the reason. I shouldn't even say possibly. The answer is no. You have to understand the reason that the Fed has got the printing press blowing and going. And that's because you're providing stimulus to an economy that needs the stimulus, which means that that they've done some very good studies on this recently. Quantitative easing is by definition deflationary in nature. That's not to say that we cannot generate inflation. Because if we shift the stimulus, truly shift the stimulus all the way to the fiscal authorities, swing the pendulum completely to the fiscal authorities, and let's say we get past this next $3 trillion bill, and that gets us to $30 trillion of US debt. But let's say that we're going to have a regime change such that we are constantly pumping more fiscal stimulus into the economy. And you've heard this envisioned by many people that if you flirt with that notion of it's okay that it's 30 trillion, I can take it to 60 trillion, I can double it, then you will see. And in order to do that, by the way, you really are going to have to recruit the Fed to directly monetize the debt at such huge, enormous levels. Then you open up the possibility of inviting stagflation, which is the worst of all worlds, which we saw in the 1970s, wherein you have rising inflation, you have rising interest rates, and you still have sclerotic growth. And if you can imagine what that does to the lowest income earners, it would just be devastating.
I'm not familiar with those studies on QE, but is it correct to assume that more capital being made available to industry, which in turn pumps out more goods, which lowers prices of said goods, that's why it's deflationary?
Well, it is deflationary in that sense, but it's not necessarily because it's productive. You are going to get asset inflation. But what I'm saying is that if you require stimulus spending, you require stimulus spending, even if it was not QE, circa 2019. 2019, banks were beginning to not trust their borrowers. And there was also a dearth of reserves in the system. So the Fed had to start pumping money into the system, but it couldn't call it QE. Once you get to true quantitative easing, which we have obviously seen in steroids in 2020, even though the pace has come down very, very much. The reason you're seeing true quantitative easing is because the economy has slowed so much that it needs the stimulus spending. And it needs the stimulus spending because the unemployment rate is going up, meaning there's less income. A recent Pew study found that nearly 1/3 of US households had lost income in a post-pandemic world. That is by definition deflationary. There is less money coming in the door, and therefore there's less money going out the door. But again, to everybody who's concerned about me talking about deflation, we have to remember that in times of economic disruption, that gold outperforms. And, or if you want to think of the next generation, Bitcoin would outperform, because that is what happens when the sanctity of a currency is in question.
Goldman Sachs out with a report last week saying that they think the Fed is going to hold off rate increases until 2025. And they seem to think that this inflation is coming and stocks are going to benefit from that, particularly, quote, commodity exposed stocks. Are you expecting to see inflation in that area, in the commodity sector?
Well, if we're going to see inflation in the commodities sector, that means that we're going to have demand increase. And if we're going to have demand increase, that means that we're going to have the economy heal. And that would certainly be a great outcome. But if you look at commodities such as copper and iron ore and steel rebar, the reason prices have found such underlying support is because China's stimulus spending is going directly into infrastructure, because they're not able to stimulate their consumer sector to the extent that they need in order to create the GDP figures they are. So they've gone back to their old playbook and they're putting money into infrastructure spending. We're not doing that. And if only one country does that, then that's not going to be sufficient. But if you're seeing case counts rise and hospitalizations increase, which we are in Europe, and we're seeing hospitalizations flatten out here and begin to increase here in the United States, that's why you've got other firms coming out and saying, you know what, we're going to take down our expectation for oil and energy and gasoline and jet fuel demand going out into 2021. We don't think that there's going to be the recovery that we were anticipating. And therefore, again, it gets us back to the discussion of deflation. Inflation is I think it's a great thing to consider having in the future, because it reflects economic dynamism and it reflects companies competing with one another for the same supply of goods. But until you can convince me that we've got some place to employ the 26 million Americans collecting unemployment benefits right now, and to stop the bankruptcy parade, and to stop the Chapter 11 filings that we continue to see despite the Fed's best efforts, which creates more permanent unemployment, until you can convince me of a way we're going to stop that cycle, then there's no inflation in the works.
Yeah, and I look forward to one day things getting back to normal, particularly travel patterns. Unfortunately, things are not going to return to normal quick enough for me to see you in New Orleans. But I want to invite everyone watching to join me, join Danielle, and join an exceptional cast of speakers, including Peter Schiff, Tucker Carlson, James Rickards, and Robert Kiyosaki at the 46th Annual New Orleans Investment Conference this year, online for the first time, October 14th through 17th. Details at neworleansconference.com. Danielle, the time always goes by way too quick when I got you on, but thank you for spending time with me again. And I look forward to seeing you online at the New Orleans Conference.
Likewise. Take good care.